Hi everyone, welcome to Awesome Strategies. In this video, I want to talk about how I plan to trade advanced micro device AMD with option. AMD stock price has been down 41% since the beginning of the year. According to Mercury Research, AMD took market share from Intel in CPUs for servers and PC in the second quarter. In the latest quarter, AMD also reported 6.55 billion sales and $1.05 a share earning, which was 67% rose on earning, while 70% increase on sales on a year-over-year basis. The full-year guidance also beat Wall Street with estimated 26.3 billion sales versus analyst prediction of 26.21 billion. However, the third quarter prediction was lower than the street expected, which is a 6.7 billion versus 6.84 billion that Wall Street is looking for. This is a one-year chart of AMD. Recently, the stock price hit the resistance level around 100 and turning back down after forming a lower high from June. Now it is moving down to support level of $83. My assumption is the stock price will hovering at this level. It may test a new low if the overall economic environment is not good and will pop if the economic environment get better. However, I'm willing to hold the stock for long term if the stock price drop. I'm optimistic about the chip market future as more and more items from car to kitchen appliance are incorporated with chips to make them smart. Remember, this is my assumption and not a trade recommendation. So, how can I trade AMD now? The first strategy that I plan to use is selling a straddle and buy out of the money call option with the same expiration to eliminate the upside risk. The strategy is set up by selling an at-the-money call option and at-the-money put option with the same strike price and same expiration date. Then buy a further out of the money call option with the same expiration date. Make sure the premium collected is more than the call spread width. As mentioned before, this strategy has no upside risk, which means even if the stock price pop higher than my short call spread, I will not lose any money. I may be able to make a small profit if the premium I collected is wider than the call spread, even though the strategy have no upside risk, but it does carry a downside risk. As a put option seller, I'm obligated to buy the stock at the strike price if the short put of the straddle become in the money at expiration. If the stock price moving sideways and stay at current price level, I'm able to make maximum profit, which limited to the premium that I collect. The second strategy that I plan to use is selling a strangle and buy out of the money call option with the same expiration date to eliminate the upside risk. The strategy is set up by selling out of the money put option and out of the money call option, then buy a further out of the money call option that allow me to collect premium which is wider than the call spread. Same as previous strategy, this strategy also have no upside risk. The range to make maximum profit also wider, but with lower maximum profit amount when compared to the short, straddle and long call strategy. Also same as the first strategy, I'm obligated to buy the stock at the strike price if the short put of the strangle become in the money at expiration. Thank you for watching, and remember, all trade discussed in this video are not trade recommendation.